it's we don't look at indicia from stocks in general or from PEs or price sales ratios or what other things are doing. We really just focus on businesses. We don't care if there's a stock market. I mean, would we want to own Coca-Cola, the 8% we own of Coca-Cola, the 11% of Gillette, if they said we're just going to delist the stock and we're never going to, we'll open it again in 20 years. It's fine with us, And then if it goes down on the news, we'll buy more of it. So we care about what the business does.
It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Before we get right into it, don't forget to like, share and subscribe to the channel for more information. Warren Buffett's statement underscores the idea that the quality of the underlying business is paramount when making investment decisions. While stock valuations are important, they should be considered in conjunction with a thorough analysis of the company's fundamentals, competitive positioning, and potential for long-term success. This approach aims to reduce the risk of investing in companies that might be overvalued due to market speculation or short-term trends. Wonderful company. Buffett believes that investing in a high-quality, well-managed company with strong fundamentals and a competitive advantage is crucial. A wonderful company is one that has a history of generating consistent earnings, has a durable business model, and is likely to continue performing well in the long run. Fair price. Buffett suggests that it's important to pay a reasonable, fair price for a company's stock. This means avoiding overpaying for stocks, even if they appear to be in high demand or have recently experienced a surge in value. Buying at a fair price ensures that you're not entering the investment with unrealistic expectations of future returns. Fair company at a wonderful price. In contrast, Buffett warns against the temptation of purchasing stocks solely based on their low price or the expectation of a quick profit. Even if a stock is trading at a significant discount to its intrinsic value, if the underlying company is not fundamentally strong or lacks a competitive advantage, it might not be a wise investment in the long term. Long-term perspective. Buffett's investing philosophy is rooted in a long-term perspective. He advises investors to focus on the potential for sustained growth and value creation over time rather than trying to time the market or make short-term gains based on price fluctuations.
If you have something you think you understand that looks very attractive to you, we think it's smart to do what you understand. If we'd been unable to find companies, we well might have been in the to it. We don't sneer at it. Other people with more talent have found that a wonderful course of action.
We generally look at businesses. We feel change is likely to work against us. We do not have great ability. We do not think we have great ability to predict where change is going to lead. We think we have some ability to find businesses where we don't think change is going to be very important. Now, at a Gillette, the product is going to be better 10 years from now than now, or 20 years from now than 10 years from now. You saw those earlier ads going back to the Blue Blade and all that. The Blue Blade seemed great at the time, but the shaving technology gets better and better. But you know that Gillette, although they had that little experience with Wilkinson in the early 60s, but you know that Gillette is basically going to be spending many multiples the money on developing better shaving systems than exist now compared to anyone else. You know, they got the distribution system, they got the believability. If they bring out a product and they say this, they got the distribution system, they got the believability. If they bring out a product and they say this is something that, when they said to women to look at it in the shaving field, they wouldn't have that same credibility someplace else, but in the shaving field they have it. Those are assets that can't be built, and they're very hard to destroy. So change, we think we know in a general way what the soft drink industry or the shaving industry or the candy business is going to look like 10 or 20 years from now. We think Microsoft is a sensational company run by the best of managers, but we don't have any idea what that world is going to look like in 10 or 20 years. Now, if you're going to bet on somebody that is going to see out and do what we can't do ourselves, I'd rather bet on Bill Gates than anybody else. But I don't want to bet on anybody else. I mean, in the end, we want to understand ourselves where we think a business is going. And if somebody tells us the business is going to change a lot, in Wall Street they love to tell you that, that's great opportunity. Chewing gum, we have a pretty good idea how they chewed it 20 years ago and how they'll chew it 20 years from now. And we don't really see a lot of technology going into the art of the chew, But, so as long as we don't have to make those other decisions, why in the world should we? I mean, all kinds of things we don't know. And so why go around trying to bet on things we don't know when we can bet on the simple things?
When Buffett mentions that the investor of today does not profit from yesterday's growth, he's emphasizing the need to look beyond past performance or recent stock price movements. Successful investing, according to Buffett, requires a deep understanding of a company's business model, competitive advantage, management quality, and long-term growth potential. By focusing on these aspects, investors can make more informed decisions that are grounded in the future outlook of the business rather than relying solely on historical data or short-term market trends. Focus on the future. Buffett's philosophy underscores the idea that an investor's decision-making should be forward-looking. Simply looking at a company's past performance or recent stock price gains isn't sufficient to make informed investment decisions. Instead, it's crucial to assess the company's future potential for growth and profitability. Earnings and value. Buffett places a strong emphasis on a company's earnings and its intrinsic value. While stock prices can fluctuate based on market sentiment and short-term trends, a company's true value is derived from its ability to generate sustainable earnings over the long term. Understanding the company's future earnings potential helps investors determine its intrinsic value. Market efficiency. Buffett's approach suggests that stock markets are not always perfectly efficient in pricing stocks accurately. This inefficiency can create opportunities for investors who are willing to conduct thorough research and analysis to uncover undervalued or overvalued companies based on their future prospects.
The careers Charlie and I have had in investing, there have always been hundreds of cases or thousands of cases of things that are ridiculously priced, and phony stock promotions, and the gullible being led into to believe in things that just can't come true. So that's always gone on. It always will go on, and it doesn't make any difference to us. I mean, we are not trying to predict markets. We never will try and predict markets. We're trying to find wonderful businesses, and the fact that a part of the market is kind of screwy, that's unimportant to us. We tried a few times shorting some of those things in our innocence of youth, and it's very tough to make money shorting even the obvious frauds, and there are some obvious frauds. And it really is. It's not so tough to find the obvious frauds, and it's not tough to be right over 10 years, but it's very tough to make money being short them. Although we tried a few times way back.
We will continue to ignore political and economic forecasts, which are an expensive distraction for many investors and businessmen. 30 years ago, no one could have foreseen the huge expansion of the Vietnam War, wage and price controls, 2 oil shocks, the resignation of a president, the dissolution of the Soviet Union, a one-day drop in the Dow of 508 points, or Treasury bill yields fluctuating between 2.8% and 17.4%. Buffett's philosophy encourages investors to look beyond the noise of market predictions and focus on the quality of the underlying businesses. This approach aims to minimize the impact of market fluctuations and short-term volatility, while seeking to capitalize on the long-term growth potential of fundamentally sound companies. Instead of trying to time the market, Buffett's strategy revolves around identifying businesses that are likely to perform well over time, regardless of the current market conditions. Ignoring forecasts. Buffett suggests that attempting to predict the future direction of the stock market, as well as economic and political events, is both challenging and distracting. He believes that these forecasts are often unreliable and can lead investors astray. Focus on businesses. Rather than trying to time the market or predict short-term fluctuations, Buffett recommends focusing on understanding individual businesses. His strategy involves analyzing the fundamentals, competitive advantages, management quality, and long-term prospects of the companies he's considering investing in. Intrinsic value. Buffett's focus on business fundamentals aligns with his emphasis on determining the intrinsic value of a company. He seeks to invest in companies that are trading below their intrinsic value, regardless of whether the overall market is considered overvalued or undervalued.